Hello everyone, my name is John Locke and I'd like to welcome you to The Winning Trade, but first the required disclaimer material. This presentation is given for educational purposes only. We're not broker-dealers or financial advisors and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial and please make sure you're aware of all your risks prior to placing any trades. Also note that all trades and results in this presentation are hypothetical computer simulated trades. They're believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading performance, wealth, and success coach with Locke in Your Success LLC, where myself and my team of mentors are here to help you win in the markets and in life as well. And today I'm here to bring you into the realm of high probability options trading. Now, high probability options trading, also known as income trading, is where we utilize option strategies that generate money or generate income through the passage of time rather than depending solely on price movement in order to make money. That means we can often make money whether the market goes up, down, or sideways. Now, this doesn't mean we're going to make money all the time, but it does give us a much higher probability of making a profit than would simply having on a directional trade. And the trading strategy that I'd love to share with you today is a strategy that we cover in our Options Trading for Income webinars every Monday morning, real time, within our Go membership. And that strategy is called M3.4U. Now, the M3.4U is a strategy I developed for our stage 3 traders. You see, we have this trading success blueprint, and they have stages 1 through 5. Stage 3 is our intermediate stage trade level. And the strategy is a somewhat bullish bias, market neutral income strategy that we trade on the Russell 2000. The strategy itself requires a minimum of $2,500 per trade in order to trade it. The example size that we're going to show you today is going to be twice that size. It will be a 5,000 planned capital trade. As far as profit targets, there is no profit target to this strategy, but in general, I'd expect a good month to return about 10% of our planned capital, or about $500 for our trade size. And our exit loss trigger, or stop loss as some people call it, would be if the position happens to draw down 10% of our planned capital, which in this case is going to be $500. Okay, so that's about it. Let's take a look. Okay, so for those of you who may be newer, this is an options analytical software called Optionnet Explorer. What this does is it analyzes your profit and loss profile of the options positions that you have on. So here you can see that there's a graph, and along the bottom is our asset price. So it's a little bit different than a price chart. A normal price chart has your asset price in a vertical manner along the right side usually. This chart actually has the asset price along the bottom. Along the right border here is our profit and loss line, or our profit and loss numbers. And the way this works is we have this sharp edge graph here, and this sharp edge graph is called our expiration line, and this shows us the value of our position or the profit and loss in our position at any given price point in the future when the options that we're using expire. And then we have this more curved, thinner line here, and that is called our T+0 line, and this shows you the software's estimate of what the profit and loss of the position will be at any given price point of the Russell 2000 as of today. Okay, so that's basically what that is. Over time, it is our expectation that this T+0 line will gravitate towards the shape of our expiration line. Now, this strategy also has something called adjustments, meaning as the asset price moves around, if it moves in a place where, well, we may not particularly like, we're going to adjust the strategy or move some of these options around to keep ourselves into the most optimal position that we can. So if we look a little further into the software, this is the date at which we are entering the trade. So this is a date in the past. This software allows you, again, to go into the past and put the position on, and it's good for making demonstrations, always also good for back testing. So we're going back to February 18th, 2022. At that time, we have the asset price of the Russell 2000 at 2008. We have our options expiration cycles here along the top. Along the side, we have our call options and our put options, and these are the strike levels. And this is the position that we actually hold. And then if we go down into the bottom here, we have our current margin, or how much capital is actually in the trade, which is also represented by the bottom of our exploration graph here. We have our current profit and loss. We have our, we call delta. Delta is the amount of money the software is projecting that this position should gain or lose with a $1 price movement in our asset, which is the Russell 2000. We have our gamma, which is how fast our delta is changing. Every time your price changes, your delta usually changes as well. We have what's called theta, which is our theoretical amount we gain or lose over a passage of 1 day. And we have our volatility, which is the theoretical amount we gain or lose with 1 point of Vega increase. And these numbers are numbers that we do like to keep an eye on, but our most significant number that we're looking at for adjustments for this particular strategy is going to be our delta. So our delta number here, we're going to try and keep between -3 and +4 for a position that's this size. If it gets outside that range, we're going to make adjustments, and we'll do that. We'll show that, demonstrate those as we go along. And let's just kind of talk about the entry. So entry, we're going to come in here 17 to 27 points under the money, which puts us at $19.90 for an asset price. We're going to sell our short options. We're going to go 60 points down for a 60-point wing here and buy our long options. And then we're going to go 40 points up and buy our other long options. In this case here, if we do that, that's our normal trade setup for entry. In other words, having two options here at 20.30 in this case. But if we do that, you'll notice that our delta is too high. I told you we had a limit of +4. So what we're going to do is we're going to take this off and we're going to move it to 20.40 so that we are within our adjustment range. So that's where we are here. As for an order, you wouldn't put these on one option at a time. What you do is you do a butterfly here, or a broken wing butterfly to be more accurate, with strikes at 19.30, 19.90, and 20.30, and then one with 19.30, 19.90, and 20.40. So you kind of leg into that. And this would be our position at entry. So as we move along here and we go forward, we hit +4. We're going to, if we go over +4 to the downside, we're going to continue widening this upper wing out to make a delta correction. If it goes too far, we're going to do what we call a roll. We're going to take the position and roll it back. And then to the upside, if we get to negative delta, then what we're going to do is we're going to move these positions in. And to control capital, we may end up moving some of these 1930s up. That's basically how that works. So let's see how we do. So I'm just going to jump in here, and I'm going to go to first adjustment. So if you remember, we entered, let's go back here. We entered February 18th. Nothing happens in this position until February 23rd, which is 5 days. And what ends up happening is we end up getting a significant down move in the market. We end up with a position delta that's over 4. So to correct that, the first thing we're going to try is we're going to move this higher and see what that does. Well, that brings us to 2.7. That's within guidelines. Notice we are drawing down some money here. We will do that if we get a hard down move right away. And if you notice, when we entered near the top of the positive delta limit on this particular trade. So that being the case, we did draw down a little bit, but we're nowhere near our stop loss number, which is going to be 500. So we're going to make that adjustment as a simple vertical. And this is going to be our new position here. So let me jump into our next adjustment. So it's February 23rd. And we literally do nothing until March 14th. Finally, and you can take a look at the price chart if you want. Basically, I think we had an adjustment down here, most likely, and then we bounced. We came back down again a little bit lower. So we have another adjustment here. We're over +4 again, and we're going to do the same thing. We're going to take one of these. We're going to roll it forward, and now we're within guidelines. So that is the move that we're making. Notice, because of the time passage, even though price-wise we're actually in even a worse location than we were before, and we were down $250, now we're only down 107. So you can see how time passage is helping us here with gaining profit and loss on this. So it's March 14th. If we go to our next adjustment, it's in 3 days. What happens here is we get whipsawed. So this is not that all that uncommon in the marketplace, especially not nowadays. The market bottoms out and then all of a sudden it takes off really hard to the other side. So we can see that happening, and that being the case, when we get to -3 delta, we actually have an adjustment. Now, when I talked about the initial adjustment on the strategy, there's actually 2 different adjustment parameters, and one of them is when you're inside our long strikes, and one of them is when you're outside our long strikes. If you're outside of the long strikes, we actually want this to be positive delta. So anyway, the market movement today pushed us outside of our long strikes. So we want to be positive delta. So we would make an adjustment here actually, even if the market was less than -3, but -3 was our limit anyway. So we're just going to do the opposite of what we were doing before. We'll roll that in and bring ourselves within guidelines. Now this doesn't bring us within guidelines, so I have to be a little bit more aggressive and do something like that, and that brings us to positive delta. So that should be the move that we made here, and it is. And this is our new position. Now, very rarely will this position be down money when we're outside the tent to the upside, but it does happen from time to time. And in this particular type of circumstance where we get a really hard down move right off of our entry, and then we get a really hard reversal, you can be drawn out a little bit, but as you can see, we're nowhere near our exit loss trigger. Let's move this forward here. We're now 28 days to expiration, by the way. Let's move this forward here to next adjustment, which is the very next day. So next day, we get a further up move and we turn negative delta. And as I was saying, outside the tent, so to speak, or outside of our long strikes, we're not allowing a negative delta. So we're going to come in here and make a correction for that. Also, we want to watch our capital in the trade. I know I said this had 5,000 planned capital, but in reality, it's kind of 4. I don't allow it to go over $4,000 capital, but here we're actually within that number. So we make that adjustment, and we're pretty much at maximum capital on this. We're +2 delta at this point. Let's move forward to next adjustment. So what happens is we end up sitting in this position for 10 days. You can see over the passage of time, we're actually gaining value even outside the tent. That does happen from time to time, but we've gone negative delta again. So I'm going to have to make an adjustment. Now this time, I'm going to do the same thing, but when I do that, it puts me over my capital limit, which is 4,000 here. So to correct for that, or bring capital out of the trade, this is a very effective way to do it. You see that brings my capital down to 3. Also throws me negative delta again. So I'm actually going to have to bring both these down and go into something like that. So that's what should have happened. That's what did happen. And this is our new position. Now, had this gone over 4 delta with that adjustment, I'd have to kick that back a little bit or maybe allow this to maintain some negative delta. But in this case here, we're within guidelines. So we're going to let that go. If we go to next adjustment here, so it's March 28th, brings us to April 4th. We have a similar situation where we've been able to sit in the strategy here. We're up $550 or 10% of our planned capital, or more than 10%, so it's looking good. And I want to bring this more negative delta. I do my adjustment here. I have too much capital in the trade, so we're gonna do that again. We're gonna bring this long up to 1950, and we're gonna bring some of these down. So the position that we're going into is going to look like this. Currently, we have what, $3,400 in the trade. We're up a good amount of money here, and we're about +1.92 delta. Now from here, we have 10 days to expiration. Let's see what happens. We end up getting a big down move the day after we make our adjustments. Hey, that happens sometimes. We don't like it to happen, but from time to time that does happen. This down move is going to push us. It takes away a little bit of our profits. That happens. It's going to push us to positive 6 delta. To correct for this, we're going to back out of these again and try to get back into range. And this actually move looks good. So let's do that. Notice that as we get into expiration and as we're getting whipsawed here back to the downside, that we're getting capital out of the trade, which is one of the things I like about this strategy. This is where we're going to go here. And then if we go to our next adjustment here, which is the following day, we get another fairly substantial down move in the market here. We end up being way over our delta limit again here. So I'm going to do -1 to bring us back in range. And this is taking a bit of a toll on us. I mean, this is a hard down move. And we're very close to expiration. So that's what happens. This is our new position. If we go to the 7th, no adjustments required here in the 7th. And by the way, I'm not looking at this trade intraday or in the middle of the day. We have a checkpoint time, and that's 3:30 in the afternoon in this particular instance. And we're checking that once a day, every day. So it's not like a day trade where you're sitting there on top of the market and adjusting stuff all day long. We're just here casually doing our thing. So this is what we look like on April 7th, 7 days to expiration. If we go to next adjustment here, this is April 11th. So let's look at what happened. Over the next few days, markets kept going down, but it kind of slowed down a little bit. And this is what we look like here. We are positive 10 delta after this $6 down move. Let's just go to the day before. So this is where we were the day before. And we're up $708. Get a bit of a down move. We're up $798. Delta's too high. We're going to be continuing to back out of these. And to bring our delta in range, I actually have to do 2 of them, which happens to put me in a symmetrical butterfly. There's our position there. Now we're 3 days to expiration. We'll just go day to day here. This day here, we end up getting a bit of an up move, but despite that, we are still to positive delta, and we're in a symmetrical butterfly. So remember I told you there's a point at which we take this and we roll the position back. This would be the point at which to do that. Now, realistically, in a live trade, I would not make a roll 2 days to expiration, especially if I'm in this type of a position, because it's really not worth doing. You have a lot of price movement risk at this point because our gamma is so high and making the roll isn't necessarily the best thing to do. But our guidelines do tell us to do that. So like in our options trade for income on Monday morning, we are going to show this rollback. So if I roll back, what I end up doing is I end up being in this position here first. Okay, so in other words, this is our base rollback. We roll back to starting position. We notice that our delta is too high in starting position. So, and our capital is too high, by the way, too, right? So I can't actually go into this position. I wouldn't roll into this position. The position I'd roll into would be this. And that would include cutting our wing sizes to the downside and to the upside and putting us in this type of a position here. And this is really a decent position. It's not bad at all. If we get another calm day or a slight down move the following day, tomorrow is our last trading day, I think. Hold on a second. Let's go to Wednesday here. Yes, that's our last trading day. The reason being that this is Friday is a holiday, so our options are expiring Thursday morning. So our last trading day on this particular is this Wednesday. And if I look at the trade on Wednesday, we end up getting a 41-point up move, which is a monster move in the Russell to the upside here. And that ended up knocking down a bit of our profits here. But basically what I would do with this here is just let it expire and let it go. But if we trade out of this, It's going to leave us with a profit of almost 20% of our planned capital in 55 days, which is a better than average but not uncommon return for the M3.4U, this episode's winning trade. If you like what you see, and how can you not, I invite you to go to lockinyoursuccess.com, that's LOCKE in yoursuccess.com, and check out our Go membership so that you too can discover how you can follow along with this and many other great trading strategies as they unfold during our weekly Options Trading for Income webinars. Also, where you can learn about upcoming winning trade presentations, receive access to free bonus material, and perhaps best of all, you can check out our free trading performance podcast where you can learn to skyrocket your trading regardless of the type of trading you do. If you have any questions, comments, or anything else you'd like to see on the next winning trade, please make sure to comment in the section below and I'll answer your questions for you personally. Thank you for joining me, and I look forward to seeing you on the next winning trade.